Cathie Wood has been one of Tesla's biggest believers, standing by the stock even during its most volatile moments. But now, she's making a move that's raising eyebrows across Wall Street. Some investors think she's doubling down on Tesla at exactly the right time, while others believe she's making a massive mistake. Here's the thing. This isn't just another bullish take on Tesla. This is one of the boldest predictions ever made about Tesla's future. And it's so extreme that even some of Tesla's biggest supporters are questioning whether it's realistic. We'll break that down later in the video, but first, please like this video and leave a comment. It really helps with the algorithm and motivates me to keep making videos every day. Now let's talk about the major risks Tesla is facing right now, because some of them could make or break the stock before this bold prediction even has a chance to come true. Tesla is losing ground in some of its most critical markets, and the numbers don't lie. In Europe, Tesla's sales have collapsed by over 40%, and for the first time, legacy automakers like Volkswagen and BMW are outselling Tesla's EVs. This is a huge red flag, as Europe was once one of Tesla's strongest markets outside of the US. In China, the situation is even worse. BYD is no longer just a competitor, it's the leader. The Chinese EV giant has not only outsold Tesla in multiple quarters, but is now aggressively expanding into global markets, posing a serious threat to Tesla's dominance. And in the US, Tesla's market share has started shrinking for the first time in years. While it still holds the top position in EV sales, companies like Ford, GM, and Rivian are all ramping up production and introducing new models to compete directly with Tesla. If Tesla continues to lose market share at this rate, it could face even more downward pressure on its stock price. And this is before we even get into the financial and institutional investor concerns that are also weighing Tesla down. And that's exactly what we'll cover next. As Tesla's stock struggles, institutional investors are taking sides. Some are doubling down, while others are jumping ship entirely. On one side, hedge funds and major Wall Street firms have been trimming their Tesla positions, citing concerns about Musk's leadership distractions and Tesla's weakening fundamentals. Some investors worry that Musk's heavy focus on X, AI startups, and space ventures is pulling attention away from Tesla at a critical time. At the same time, Tesla's insiders have been selling at record levels. Musk's brother, Kimball Musk, has dumped millions in Tesla stock, and even the company's CFO has been offloading shares. While insider selling doesn't always mean trouble, the timing, when Tesla is already under pressure, is raising serious red flags. And yet, not everyone is turning bearish. Some funds are actually increasing their exposure to Tesla, arguing that the current dip is a rare buying opportunity. They believe Tesla is still far ahead in EV and AI technology, and that once the market stabilizes, Tesla's stock could surge again. But here's where things get really interesting. Cathie Wood isn't just holding her Tesla shares. She's going all in. That's right. Despite all the concerns, the volatility, and the analyst downgrades, Cathie Wood is making one of the boldest Tesla bets we've ever seen. But the real question is she onto something? Or is this the riskiest call of her career? We'll get into the details of her massive Tesla prediction next. Cathie Wood has never been shy about her belief in Tesla's long-term potential. But now she's making her most aggressive prediction yet, one that's turning heads across Wall Street. According to ARK Invest, Tesla's stock could skyrocket to $2,600 per share by 2029, an increase of over 800% from current levels. If this prediction comes true, Tesla wouldn't just be the world's dominant EV maker, it would be one of the most valuable companies in history. So what's behind this insanely bullish price target? Wood and ARK Invest believe that Tesla is no longer just an EV company, it's an AI and robotics powerhouse. Their argument is built on several key factors: full self-driving and the robotaxi network. Wood predicts Tesla's FSD software will gain full regulatory approval, allowing Tesla to deploy a fleet of autonomous robotaxis. She believes this will completely disrupt traditional car ownership, creating a massive recurring revenue stream for Tesla. Wood told Bloomberg that she expects Tesla's robotaxis to be the company's biggest value driver in the next 5 years, and that the share price was not even factoring in Tesla's plans for humanoid robots. While most investors focus on Tesla's EVs, ARK Invest sees its energy division and AI advancements as the real game changers. Wood has consistently argued that Tesla's AI capabilities extend far beyond cars, with applications in automation, data analytics, and even robotics. She believes Tesla's energy storage products, like its megapacks and solar technology, could become a dominant force in the global energy transition. Tesla's ability to lower costs, scale production, and dominate multiple industries is central to ARK's thesis. Wood sees Tesla expanding its manufacturing efficiency through innovations like its gigacasting technology, which allows for faster, cheaper production. She also believes that Tesla's vertically integrated supply chain and continued breakthroughs in battery tech will give it a long-term competitive edge over both legacy automakers and emerging EV competitors. But perhaps the most controversial aspect of ARK's prediction is its assumption about Tesla's AI dominance. Wood argues that Tesla is not just an automaker. It's a software company, an AI company, and an energy disruptor all in one. In her view, Tesla's AI-driven businesses, FSD, robotaxis, humanoid robots, and AI-powered energy solutions, are massively undervalued by Wall Street. However, not everyone is buying this vision. While Wood sees Tesla heading to $2,600, some analysts are warning that Tesla won't rise above $400 if its current problems continue. The big question is, who's right? Is Cathie Wood seeing something that the rest of Wall Street is missing? Or is this just another overhyped stock call that could lead investors into serious trouble? And the answer might lie in one crucial factor that Wall Street analysts are laser focused on right now: Tesla's declining market share and growing competition. Europe is slipping away. Tesla's market share in Europe has collapsed, with companies like Volkswagen and BMW outselling Tesla in key regions. Recent data shows that Tesla's European sales dropped by over 50% in February alone. This is a massive concern because Europe has been one of Tesla's strongest EV markets. If Tesla keeps losing ground here, it could significantly impact its global revenue. China's EV war is heating up. Tesla is facing its biggest competitive challenge yet in China, where BYD continues to dominate. In fact, BYD has now crossed $100 billion in annual revenue and is rapidly expanding its presence beyond China. Tesla has resorted to price cuts to maintain demand, but this strategy is squeezing profit margins and could backfire in the long run. Regulatory headwinds in China. Tesla recently had to halt its assisted driving trials in China, pending government approval. This delay highlights how vulnerable Tesla is to regulatory challenges in one of its most important markets. If China tightens restrictions further, it could make it much harder for Tesla to expand its full self-driving FSD technology there. Beyond competition, analysts are also raising concerns about Tesla's declining profit margins. Tesla's aggressive price-cutting strategy has worked in the short term to boost sales, but it's also reducing the company's profitability. At the same time, materials and production costs remain high, putting even more pressure on margins. This is why some analysts believe Tesla's stock is still overvalued, even after its major decline in 2025. Analysts from Morgan Stanley and Goldman Sachs have warned that Tesla's future growth assumptions might be too optimistic. Some believe Tesla is no longer the clear EV leader, as traditional automakers and new startups like BYD are catching up fast. Others argue that Tesla's AI narrative is still unproven, and until FSD gains full regulatory approval and starts generating significant revenue, it remains a speculative bet. So, while Cathie Wood is projecting an 800% increase, some analysts are questioning whether Tesla can even sustain its current valuation. But there's one more major factor that could determine Tesla's future: the institutional investor battle over Tesla stock. And the divide between bulls and bears has never been sharper. Also, retail investors are doubling down on Tesla, even as institutional players offload their shares. According to TipRank's data, retail traders have been steadily accumulating Tesla stock, seeing the dip as a rare opportunity to buy in at lower levels. The increase in retail buying comes at a time when Tesla's stock is down nearly 50% from its peak, sparking debates on whether this is a true bottom or if further downside is ahead. This trend isn't new. Tesla has long been a retail favorite, with individual investors historically driving major rebounds. During previous downturns, retail buyers have helped Tesla recover from steep sell-offs, often going against the bearish sentiment on Wall Street. However, the current situation is different. Institutional investors, hedge funds, and even some of Tesla's own executives have been selling, raising concerns that the recent surge in retail buying might be an emotional bet rather than a strategic one. If Tesla's fundamentals don't improve, especially in key areas like global sales, AI development, and energy expansion, retail investors could find themselves in a buy-the-dip trap, where they keep averaging down while the stock continues to slide. The battle between retail optimism and institutional skepticism will determine whether Tesla's stock can mount a real comeback or if more pain is ahead. The big question now is, should retail investors follow the institutions selling Tesla, or should they side with ARK Invest and Cathie Wood's long-term bet? And that brings us to the final question. What are the actual catalysts that could push Tesla's stock higher? Despite all the concerns, there are a few key factors that could still drive Tesla's stock upward. If Tesla secures regulatory approval for FSD, it could unlock a massive new revenue stream. The company's energy division, particularly megapacks and home battery storage, is growing and could become a bigger part of Tesla's business. Tesla's expansion into global markets, including China and India, could boost long-term growth. However, all of these depend on execution. If FSD continues to face delays, if Tesla's energy division fails to scale, or if competition from companies like BYD erodes its market share further, the stock could remain under pressure. So the real question is, do you think Cathie Wood is right, or is Tesla still in trouble? Drop your thoughts in the comments, and don't forget to subscribe for more in-depth Tesla analysis.